Swayam Prabha. Digital India. Educated India.
Welcome. We will be discussing in session 15 on foreign exchange exposure. So, in foreign exchange exposure before starting the foreign exchange exposure, we should understand the difference between exposure and risk. Exposure, when there is a volatility in foreign currency market, it creates exposure, and volatility when crystallized, it creates some kind of loss, it is a risk. When exposure are crystallized, it is a risk, and before risk, whatever the volatility we witness, these are the exposure. Exposure and risk, two different concepts, and on that basis three different kind of exposures are being identified for foreign currency market. We will be discussing what is called a transaction exposure. Then second we will be discussing about what is called a translation exposure, and also we will be discussing about operational exposure. So, we will discuss about foreign exchange exposure. Foreign exchange exposure I mentioned here. In a market determined exchange rate regime, exchange rate fluctuate on the basis of demand and supply, and this fluctuation of exchange rate create risks in the foreign exchange market. And when foreign exchange exposure is a measure of potential firm's profitability, that is when exposures are foreign exchange exposure or the corporate are having assets and liability in denominated in foreign currency, it affects their profitability, it affects their net cash inflow, and also because it affects that the profit and also operational expenses. So, when foreign exchange in a corporate and foreign exchange assets and liabilities are there, when exchange rate fluctuates, the value of the assets and liability also fluctuate. The assets and liability provide what is called a profit, and when asset liability themselves fluctuate, profit and profitability also fluctuate. The net cash position, any open cash in foreign currencies are there, that also fluctuate because exchange rate itself fluctuate. With the liberalization of foreign exchange market, the corporate now having exposure in different foreign currency. The corporate, particularly big MNC, have their own subsidiary, have their own company, have their assets and liability segregated to different currency, and all the subsidiary, all the assets liability which are denominated in different currency are exposed to foreign exchange fluctuation, and this foreign exchange fluctuation create some kind of risk for the corporate. The risks are being segregated into two parts. What is called, one part is transaction risk, another part is what is called economic exposure or transaction exposure, economic exposure, and translation exposure. When asset liability which are daily in nature, particularly export, import, payments and receivables are there denominated different currency, everyday transaction take place, the everyday fluctuation exchange rate create transaction exposure. When asset liability spread over the year and the future cash flow also affected because of the foreign exchange fluctuation, this create what is called economic exposures. And when the company having number of subsidiary in abroad, they converted the subsidiary are trading in different foreign currency, and when convert the foreign currency into a domestic money, there will be foreign currency exposures are there. These are called translation exposure or accounting exposure, and translation exposure, accounting exposure only for a time frame, because we generally prepare the balance sheets once in a quarter or once in a year, and as asset and liability converted into but home currency at a particular rate, and since rates are fluctuate, which rate they have to convert the foreign currency, that creates translation exposure. So, we will be discussing about all this exposure in different sessions. Today, we will be discussing about transaction exposure and try to address the issue of transaction exposure and some kind of assessment of transaction exposure. So, as I mentioned, the sensitivity of home currency value of assets and liability which are denominated in foreign currency to unanticipated changes in exchange rate is known as transaction exposure, because home currency value changes, because why it is changes, the exposure or the assets liabilities are in other currency, in foreign currency. When they convert into domestic currency, the domestic currency the fluctuation of domestic currency creates some kind of transaction exposure or transaction risk. So, unanticipated changes in exchange rate also have effect in future sales, future prices and cost, because when exchange rate changes, the future sales also affected because of fluctuation of foreign currency. The operating cost of the company also changes because of fluctuation of foreign currency. This type of exposure which affect the future position of the foreign corporate, it is known as operating exposure or economic exposure or strategic exposure. And other kind of short term exposure is also known as translation exposure or accounting exposure. As I mentioned, different MNC have different subsidiary in different countries, and when the MNC or the home company or the parent company wanted to have this balance sheet, they want to merge the subsidiary balance sheet into its own parent balance sheet and give what is called the balance sheet of the entire company. Since subsidiary balance sheets are merged with the parent company balance sheet to provide the entire company balance sheet, the subsidiaries are being traded, or assets or liability are in different currency. The conversion of foreign currency subsidiary assets and liability creates some kind of exposure. These exposures are accounting exposure, because on accounting sense the exposures are there, in the real sense there is no exposure. Since we prepared the foreign currency, we prepared the your balance sheet at a particular point of time, on that particular point of time there is translation exposure, and other than there is no exposure at all. Since for that reason translation exposures are not an exposure, it is only for conversion of subsidiary balance sheet into parent company balance sheet, some exposures are there. In real sense there is no exposure. However, in real sense we have transaction exposure, because day to day transaction are being affected because of fluctuation of foreign currency. We have economic or operating exposure or strategic exposure, because our future plans, future sales, future prices, future operating costs are being affected because of fluctuation of foreign currency. We have a strategic exposure because of that reason, and we are going to discuss about the transaction exposure and also operating exposure in different session. To this session we will be discussing about transaction exposure. Let us discuss about transaction exposure. Transaction exposure, as I mentioned, it measures the gains or losses that arise from the settlement of exchange rate, the settlement of existing financial obligation, because the financial obligation may be existing financial obligation, may be a export, may be import, and whenever there is a fluctuation of exchange rate, the value of the export is go on changing, value of the import also go on changing, and because of this reason the corporate or the exporter may face what is called a transaction exposure. The transaction exposure arises from purchasing or selling on goods and services on credit basis when prices are stated in foreign currency. We are purchasing some goods or we are selling some goods, then the goods prices are in foreign currency. Whenever there is a foreign currency fluctuation, the value of the goods and services changes, we have foreign transaction exposure. When borrowing or lending funds, when payment is to be made in a foreign currency, when a borrowing foreign currency from abroad, and we have to pay principal, we have to pay regular interest. Since the fluctuation of foreign currencies are there, the principal value changes, the interest payment also changes, so we have transaction exposure. We are lending foreign currency, we are giving foreign currency to some other person, the person is repaying us in the form of principal, in the form of what is called interest payment. Since the principal, interest payment, future payments are there, future receivables are there, since the exchange rate fluctuates, future receivables also fluctuate, it is a transaction exposure. Foreign currency denominated receivables, all kind of receivables, it is a export receivable, it is a interest payment receivable, it is a principal payment receivables, all receivables. If the receivables denominated in foreign currency, the currency fluctuation change the value of the receivable, and it is a transaction exposure. A transaction exposure is actually created at the first moment the seller quote a price in foreign currency term to a potential buyer. When a transaction exposure is created, when it will be created? When a seller quote a foreign currency to a foreign buyer. The foreign buyer will pay not instantly, after some time will pay. Whenever there is a time difference in payment, it creates a transaction exposure. So, transaction exposure is because of export side, because of import side, because of foreign currency payment, foreign currency receivable, foreign currency lending, foreign currency borrowing, all are transaction, and all these transaction create transaction exposure, because the underlying asset is a exchange rate which value fluctuate, and there will be exposure or there will be risks in foreign currency transaction. So, all transactions which are denominated in foreign currency are foreign currency exposure, and how to assess the exposure we will discover. Two different processes are there for assessing the exposure. To understand the assessment of transaction exposure, let us do a problem. You can see the problem. An Indian firm sell merchandise and on open account to a US buyer for US dollar 285,000, payment to be made in 30 days. The current exchange rate is 525050 per dollar, and the Indian seller expect to exchange US dollar received for 149,063,925. When payment is received, the transaction exposure arise because the dollar may not remain as 525050. What does it mean here? This example which I mentioned here, Indian firm sell merchandise export to a US buyer, and US buyer supposed to pay 2,85,000 in 30 days. So, there is a 30 days time period, the US buyers will supply foreign exchange but to amount $2,85,000. So, when the merchandise, the Indian firm export US dollar, Indian firm export US dollar export amounting to 2,85,000, and this export payment come to the Indian firm after 30 days. Repayment would be after 30 days. When they actually export, that time Indian currency was currency market US dollar was quoted $1 525050, and after 30 days the exporter will get 2,85,000, and the 2,85,000, suppose today the exporter get, he will convert at 525050 and get the rupee amount. But after 30 days we do not know what will be the rate of US dollar, and this create a transaction exposure, because dollar and rupee conversion rate after 30 days may not continue at 525050, and it create a what is called a transaction exposure. A transaction exposure, how it create? A transaction happened, the transaction is export amounted to US dollar 2,85,000, and this at the current rate of 525050, but this dollar may not remain as 525050, it create. So, whenever the person get $2,85,000 at this rate may not continue, it create transaction exposure. Suppose the US dollar after 30 days US dollar quote as, suppose quote $1 is equal to $1 quote at 525005. So, when 5005 quote, when the exporter got after 30 days this amount of dollar 2,85,000, he will convert at current rate, the current rate is 52500, which is less than 525050, which was prevailing before 1 month when actually exported. So, it creates a transaction loss, Suppose scenario 2 is there, suppose US dollar quote 526050. So, this is more than 5050, it will create a transaction profit for the exporter, but exporter cannot know whether he will be in loss or he will be in profit. So, anything which create a risk for him, the risk or exposure is a transaction exposure. So, chances of loss or gain depends upon the future market, and future market is uncertain, and this transaction lead to a uncertainty, and it is a transaction exposure. Okay. Now, this is called open account purchase or selling, is open account, because this account what you discuss, why it is called open account? It is open account because this dollar 2,85,000 is open in the sense that we have not, the exporter had not purchased any kind of risk management product for converting the future cash flow at a particular constant amount. Because if the exporter purchase a risk management product in the form of forward contract, in the form of foreign currency futures or options, his value of future value remain constant. So, there may not be any transaction exposure. Here it is a open account, there is no purchase of foreign currency hedging product. So, the open account, it is value is open, value is may come down, may increase, depends upon the future US dollar and Indian rupee exchange rate. They open because it may go up, it may come down, it depends upon the market exchange rate. So, there is a open account because there is no foreign exchange forward or foreign exchange future hedging product purchased by the exporter. Now, come to another problem, what is called a borrowing and lending problems. Here also we have to understand that I mentioned earlier that any kind of borrowing or any kind of lending where foreign exchange is involved, it creates a transaction exposure. The corporate is borrowing foreign currency. So, corporate has to, Indian corporate is borrowing foreign currency from abroad, corporate has to pay the principal after maturity, and till the maturity the corporate has to repay what is called interest amount in foreign exchange. So, there will be a risk, and the risk is, since the payment and future oriented, any fluctuation of exchange rate, it is exposure. So, it will create a foreign exchange transaction exposure. Similarly, a Indian corporate lends a foreign currency to some abroad partner, abroad person, to a abroad person, it also create what is called foreign currency transaction exposure, because the lender received interest payment from the borrower in foreign currency, the lender received the principal payment from the borrower in foreign currency which are future oriented. So, all these transactions which are future oriented, which repayments are future oriented, create transaction exposure. So, let us discuss a borrowing and lending side. If you see the problems here, an Indian company has long term exposure in the form of commercial borrowing in US dollar. It has taken a 10 years commercial loan of 200 million US dollar in 2003. The interest rate for the same loan is linked to 6-month LIBOR and payment will be made in US dollar. In 2003, the US dollar and Indian rupee spot rate was 52.5050. So, here two kind of exposures are there. First kind is, you have to understand here that is a long term exposure, because a Indian company has got a commercial borrowing from in US dollar for 10 years. He borrowed in 2003, he is supposed to repay the principal in 2013, 10 years will be over. So, that time the principal payment will be made, but in the meantime the Indian company has to pay interest payment. The interest payment generally is 6 months, every 6 months interest payment will be there. The interest payment linked to LIBOR, 6 months LIBOR, every 6 months what is the LIBOR rate, that rate interest payment will be there. Since LIBOR is itself fluctuate, it will create another kind of risk. The foreign currency fluctuate, it creates risks, LIBOR fluctuate, it also creates risks. So, here the Indian company faces the commercial two kind of risks, one is foreign currency exchange rate fluctuation risk and LIBOR rate fluctuation risk, two different risks are there. So, here long term exposures are there. The long term exposure 10 year debt borrowing or commercial borrowing involving US dollar 200 million. And in 2003, when the actual borrowing took place At that time the spot rate was US dollar 52.5050 at the spot rate. At this rate the Indian company got the $200 million and he is supposed to pay return the $200 million after 10 years, that is 2013. In between the company has to pay interest rate which is linked to interest payment is 6 months, every 6 months has to pay, and this linked to LIBOR, London Interbank Offer Rate. London Interbank Offer Rate is a fluctuating every moment, and 6 month LIBOR is linked to 6 month LIBOR. So, every moment the interest rate fluctuate, every moment there is a risk. Every 6 months the company Indian company has to pay interest rate. So, every in foreign currency. So, for Indian company does not know what will be the foreign currency after 6 months. So, there is a transaction exposure risk. So, now the payment half yearly to pay payment. So, the payment will be made half yearly. So, there will be risk. The payment linked to LIBOR will still fluctuate, there is a risk. Suppose we understand that suppose that here if you see that suppose in 2003 when actually payment took place, that time the dollar rate was 52.5050. The principal he got, how much principal he got? The 2003 suppose the spot rate was 52.5050 into 200 million he got, 200 million US dollar, he got how much? 10501 millions of rupees. So, he got million rupee, 10501 million rupee he got. Now, in 2004 suppose he wanted to repay 2004, if he wanted to repay suppose that time dollar is trading at 53.5050, it is not 52.5050, now increased to 53.5050, there is a transaction risk. Similarly, suppose 2005 he wanted to repay the loan, so it will be 54.6060, the repayment will be 10920. So, dollar is changing, the amount of principal payment also fluctuate. In 2012 actually repayment took place, that time dollar is 60.2000. So, he has to pay, the Indian company has to repay 12040 amount of what is called principal amount. So, but he got how much? He got 10501 principal, but because dollar is fluctuating and 2012 actual repayment took place, that time he will pay 12040. So, he received in 2003, the Indian company received 10501, if rupee remain constant and at 52.50, there will be no transaction exposure. But the rupee increases, suppose 53.50560, the amount will be 10701. So, transaction exposure is 200 million. Similarly, rupee. Similarly, 2005 suppose you want to repay, that time rupee is 54.60, the actual repayment will 10920 rupee, millions of rupee, transaction exposure is 419 millions of rupees. How we calculate this? I have calculated 52 is a spot rate. Now, suppose in 2004 you wanted to repay, repayment suppose repayment of principal took place at 2004. In 2004 US dollar is $53.60 5060, suppose it may be different, suppose 5060. How much would repay? $200 million. So, rupee is 5350. So, how much will repay? 53565060 105060 into 200. So, this amount to 10701, but actually how much he got? 10501. So, but he repaying same principal, interest I am not calculating here, so interest will be separate tricks. So, only principal payment repayment supposed to return principal $200 or equivalent of rupee of 10501 millions, but actually repaying 10701 millions of rupees. Why this arises? Because exchange rate, when we borrowed that time exchange rate 525050, now it is 535060. Because of this is extra amount he is paying. Extra amount is how much? 10701 minus 10501, this is 200 millions of rupees extra he is repaying, only principal amount, that is transaction exposure. And this same thing I have calculated here for 2005, 2012, and the principal itself creating a different amount is paying because of change in exchange rate or fluctuation in exchange rate. It is a transaction exposure, it is a principal payment only. Let us come to the interest payment side. Interest payment side, every 6 months he have to repay the interest, every 6 months he is supposed to repay the interest. Here suppose in September he is borrowed in March. Now, every 6 months has come September 2003, 6 month LIBOR as Indian rupee at that time 525050, and LIBOR is 6.25 percentage, the interest amount will be 6.25 percentage. So, inside his 6.25 millions of US dollar and interest amount in millions of rupee, rate is 525050 into 6.25 millions of rupee, it will be 328.16 millions of rupee. So, there will be no transaction exposure. Why? Because the current rate is 5250, the spot rate remain constant. Suppose spot rate change, spot rate is a March 2004, again after 6 months again interest payment will be there. So, at that time rupee become 535060, dollar also LIBOR also changed to 6.85. So, 6.85 he has to pay. So, now 366 if you multiply the into 6.85 into $200, 6 month interest rate. So, it become 366.52, but since dollar has changed to from 525050 to 535060, the difference has come around 38.36, extra payments are there. So, here the calculation is like that. Suppose at the September dollar rate remain constant as $1 is 525050, LIBOR interest rate is 6.25 percentage, and 6 month interest payment will be 6 month basis, so 6.25 millions of US dollar in million, because the amount principal borrowed is 200 million, every 6 interested annualized is 6.25 into $200 into 1 by 2, because yearly interest rate 6 month interest rate amount will be 6.25. The calculation is 6 month interest rate, interest rate is 6.25 percentage into 200 millions US dollar into half yearly. So, it is come 6.25 millions of US dollar. But if interest rate remain constant at 525050, then rupee equivalent will be rupee equivalent of interest payment will be 6.25 into 52.5050, it is coming around 328.16. If interest rate, if dollar rate remain constant, then it will coming at 620. This is September 03. Now, next 6 months is March 04. Suppose March 04 has arrived. So, but here dollar may not remain constant, $1 suppose increase to 53.5060. Now, dollar may not remain constant after 6 months. Now, it is appreciated, rupee depreciated to 53.5060. Now, what will be the interest payment? LIBOR, at the same time LIBOR may not remain constant as 6.25, LIBOR itself is fluctuating. So, LIBOR become 6.85 percentage. Then interest payment will be in US dollar, it will be 6.85 US dollar in million, but this rupee equivalent how much? Rupee equivalent will be 6.85 into, now dollar has changed to 53. So, 53.5060, this is coming how much? This is will be 366.52. This is, now you see 6 months before it was 328.16 millions of rupee. Now, 6 months after it becomes 366.52, there is transaction risk. So, the Indian company need to pay more. Why it is paying more? The principal amount remain constant 200 million. Here he is paying more because rupee has depreciated from 52.5050 to 53.5060. One reason. Second reason is the LIBOR is fluctuating from 6.825 to 6.85. These two reason, because of these two reason, that the Indian company is paying more, and this open position he has not purchased any kind of risk management product to make the LIBOR constant or to make the rupee constant. And there is open position in two sides. One side is dollar side conversion rate is open position, interest payment side LIBOR is open position. Both open position created a transaction risk for the company, and company is going on paying a different amount at different phases of payment, and this is called a transaction exposure and in lending and borrowing side. And same thing I mentioned here, rupee dollar conversion goes on appreciating, or rupee go depreciating further, and at the same time LIBOR also appreciating. So, there will be more transaction exposure in this process, and this process the transaction exposure is two way. One way is LIBOR fluctuation, another way is rupee dollar fluctuation. Both side the transaction exposures are there. So, then question is how to treat this transaction exposure or how to manage this transaction exposure. The sort of treatment for transaction exposures are there, because transaction exposure create uncertainty in the payment and receivable side. It create uncertainty in international trade, it create uncertainty borrowing lending side, it create uncertainty in any kind of fund exchange transaction side. So, it need to be prevented or need to be observed in a different management practices. The practice is available to us through the what is called transaction exposure management system. The transaction exposure management systems are there. The 4 key steps involved in treatment of transaction exposure. The first is you have to record the transaction exposure. Initial recording of transaction exposure is very important. Then second is recording of outstanding foreign currency balances, because we have to identify transaction exposure first time, and what is the open position of transaction exposure in foreign currency, that has to need to be identified. And then you have to understand whether I am gaining because of transaction exposure, I am losing because of transaction exposure. So, that some kind of forecasting you have to make for gain and loss of transaction exposure. And finally, is settlement of foreign currency receivables and payment. Here to settle the foreign currency or transaction exposure loss or gain by going for what is called risk management product, and risk management products are available to us in the form of forward contract, huge foreign currency futures, foreign currency options, and also some extent we have the negotiating skill. Suppose negotiating skill in the form of operational risk assessment approach, and this process also some extent help in minimizing the transaction exposure. If you negotiate with your party that I am going to pay a constant amount, then transaction exposure automatically removed. But the negotiation skill depends upon the bargaining power of two parties. If one party is very high bargaining power, he can negotiate, but two parties are both are same bargaining power, they have to come to a negotiation side and they negotiate that there should be a transaction exposure, let us take the transaction exposure 50-50 side. In this process, we can minimize the transaction exposure. So, transaction exposure, how to treat it? The different way to treatment, and the treatments are available to us in the form of forward currency management system. The forward currency management system in the form of future currency, foreign currency options and foreign currency forward trade, and we will be discussing about foreign currency forward side, how you can use the transaction exposure management system. Let us discuss the problems. First problem, an Indian exporter export on 28th of December 2011 US dollar 1,65,000 worth of garment to a equivalent to a US on 3-month credit basis when the US dollar was equivalent to 51.5500. An Indian exporter, he exported garment worth of 1,65,000 US dollar on 20th December 2011, and that particular day the exchange rate market quoted rupee as 51.5050 per dollar. The payment would be made, it is a few after 3 months payment will start on credit basis he exported. Here the Indian exporter exported on credit basis, means the US person got the export on credit side, he has to repay within 3 months in different installment amount, and payment would be made in 3 installment due on 20th March 2012. 25% of the amount, that is 1,65,000 will be paid on 20th March. 15th April 2012, 65% of the 1,65,000 will be paid in on 15th April, and rest amount on 20th May. 3 installment 1,65,000 US dollar will be repaid by the US importer to the Indian exporter. However, 3 installment will be paid in 3 different time period, and in 3 different time period rupee dollar fluctuating in the market, and we have a transaction exposure here. The Indian merchant is a transaction exposure. In the meantime, rupee dollar fluctuation are there, and it was expected that the exchange rate will be 50.85 on 20th March, 53.25 on 15th April, and 53.25 on 20th May of per US dollar. So, in this process exchange is fluctuating, and the rupee dollar will be 50.85 on 20th March, 51.65 on 15th April, and 50.25 on 20th May. So, different exchange rate, all this different, all this exchange rate, rupee exchange rate different from the current spot 51, 55. So, that is a transaction exposure. The question is here, you have to identify transaction exposure and estimate the amount of exposure. Now, let us do the problem. What is the problem? On 20th April, on 20th December 2011, Indian exporter exported US dollar, some exported what? Garment equivalent of US dollar 1,65,000, and on this rate spot market exchange rate was $1 is equivalent to 51,500, and this was exported on this time 51,550 was Indian rupee. Now, this repayment of US dollar 1,65,000 spread over 3 installment. The installment due first due as on March 20th 2012, how much? 25%. Second due is April 15th 2012, 65%, and last May 20th